Hi, many of you may have come across a recent Economic Times article that talks about the Income Tax Department issuing notices to certain taxpayers, informing them that they have information about their real estate dealings outside of India, specifically in locations such as UAE, Switzerland, and Portugal. The Income Tax Department has sought explanations from these taxpayers on the sources of funds to check if these investments have been made with tax-paid money. There are two reports in the public domain that talks about the current market situation in relation to real estate investments. One, Goldman Sachs in its report has mentioned that increasingly HNIs are looking at local residency program which involve investments in real estate transactions as an attractive proposition, and they would continue to do so. Two, Sotheby's International has also released a report which says that of the HNIs that they have polled, around 61% of them believe that investment in real estate assets would prove to be an important hedge against inflation. The Economic Times article advises taxpayers to have robust documentation to justify their investment outside of India and to prove to the Income Tax Department that the investment they have made is with tax-paid income. All of us are aware that the Indian Exchange Control Regulations under the liberalized remittance scheme permit Indians to invest up to $250,000 in investments outside of India, including real estate transactions. It's important for us to understand the timing of the scrutiny and whether this has any linkage to the recently concluded G20 summit under the Indian presidency, and also the announcement made in the recently presented union budget. For certain HNIs, countries such as UAE, Switzerland, Greece, Portugal offer attractive residency-based programs if they make certain investments in their real estate. The general perception is that investments in these kind of residency programs are not through tax-paid money. We are all aware that Indians are required to report their foreign assets and foreign income in their income tax returns. Even under the black money law, if there is an omission to disclose these kind of assets or incomes, there is a penalty which is attracted along with 30% tax on the value of these foreign assets and income. The Economic Times article mentions that the Indian Tax Department has obtained information from their foreign counterparts under the CRS, a common reporting standard. Let us try and understand how the recently concluded G20 under the Indian presidency has played an important role in changing the definition of CRS and expanding its scope, and how it impacts those people who are planning to make real estate transactions in the near future. In July of 2023, under the Indian presidency of G20, the OECD has issued a report on real estate transactions. While the report talks about several aspects, I would like to discuss three specific topics which I believe would be of use to you and me. 1. Widen the scope of common reporting standard. The report mentions that the current scope of CRS is only to share information pertaining to financial transactions. The report says that the scope of CRS should be expanded to even cover real estate transactions. The report says that the scope of CRS should also be applied to notaries, lawyers, and transfer agents in the respective overseas jurisdiction to real-time report real estate transactions to the domestic government. Of course, once the information is with the domestic government, it becomes far more easier to share that information with their Indian counterparts. 2. The OECD report also says that a specific legislation be introduced in the respective countries where quoting of tax information system or TIN be made mandatory in all transactions involving real estate transactions. We are all aware that India already had a similar law where quoting of permanent account number or PAN was made mandatory in all transactions. One can imagine how India has been able to persistently push this point in the OECD and G20, making it mandatory for other countries to introduce similar legislations which will help exchange of information. 3. Digitization of land records. The OECD report mentions that countries such as Belgium and Finland already have 100% of their land records digitized. What this means is, whenever there is a sale or acquisition of a real estate in the respective countries, the domestic government is automatically informed about these transactions. We must remember that in the budget speech of July 23, the Honorable Finance Minister also made a mention of a similar scheme of digitizing urban land records using GIS, also called as the Bhu Aadhaar. Now, while this concept is not very new to India, we can just imagine the implications it will have going forward to report real estate transactions. This to Indian government is expected to bring two benefits. One, all real estate transactions happening domestically will be within the purview of the government. Two, the government will be able to share information about land dealings of foreign citizens with the foreign counterparts, and in the process obtain information about Indian citizens dealing with real estate transactions in overseas jurisdictions. One can imagine the role this will play in gathering information and help better tax administration, reporting and compliance. I'm happy to talk on this topic more. Please do feel free to reach out to me.